Thursday, December 1st, market analysis, Stan Ehrlich. Well, I start out with my S&P 500 as usual. We've got a very important high this morning. And today I'm going to make the recording a bit shorter than yesterday's lengthy one and concentrate on the stock market indexes only. We gapped up this morning a little bit on the S&P, a 1.5 or so, not a lot. But within a very short period of time, we punched against a major bear trend line. This bull bear trend line across the tops of the market since January 4th, the beginning of the bear market, has already been tested a couple times. You could have drawn the line off the high maybe a week or two later from March 29th. You had a bear trend line. It stopped the rally that we had in August, the middle of August. And again, we are now at that same line. In order to break a trend line, you've got to close above, and some people say for a couple of days, maybe even a certain amount. But the point is, it gets above the line, and then it continues within a short period of time to make higher highs as well. It's a very important barrier. Not only that, it's also at a historical support and resistance level by the yellow dashed line that happens to intersect at almost the same prices. Not only that, the high this morning was above the gap closure. Now that old gap is now closed, and that was from September 12th to September 13th. So that's finished. Not only that, the high is very close to an important high before it just gapped down on September 12th. And that price level, approximately 410, proves to be good support resistance historically, as well as a profound event on February 24th at the same levels. So, bear trend line, resistance levels, old gap closure, and RSI is very close to being overbought. Close enough, question mark, maybe. During the last couple of months, we saw it get up to, on October 26th, not quite my overbought level, but the market within a day or two topped out. In fact, it had a bearish engulfing. Unfortunately, it didn't get overbought, so therefore I didn't get a bearish red signal. For 2 days, it dropped sharply. That happened to be the test of a previous head and shoulder bottom neckline and zoom right back up again into new high ground, finally reaching its minimum upside objective from the head and shoulder bottom, and that was on November 15th, pulled back for a couple of days to a little bit of support, and then started this trading range that until yesterday, late in the day, last 2 or 3 hours, after the Fed made comments, we went right through the resistance level after the same day testing support earlier in their morning, and then zoom breakout. But that's not a very big trading range vertically and or horizontally. And so the minimum upside objectives have been reached by this particular rally today. That's another reason to think that the market is likely, I'll use that word, to be topping out. We are currently trading only a half a point lower on the day, 0.47, lower than the previous close yesterday, which was a whopping 12 points higher. Typically, markets absorb either bullish or bearish news fairly quickly, matter of minutes to hours. It might take a day or two, depending upon circumstances, but that was a very significant several-hour rally yesterday, and a little bit of a follow-through on the opening this morning. It gapped up. Is that an upside exhaustion gap? Well, it could very well have been, past tense. Bumped against all the things I've just mentioned, and we're starting to slip a little. Closing a little higher, a little lower, not very convincing to me. I need to see this thing start to close significantly, say 4, 5, 7 points lower than yesterday's close, and then get some follow-through for a day or two, even more than that. I want it to come back at a minimum down into the trading range we just broke out of yesterday. So if we get down to 390 and start closing below that level, and that's 17 points from where we are, that would signal to me that this is the turning point, past tense, by maybe it'll take a few days. That'd be extremely profound. If that is the case, we probably have started a leg down that will challenge the lows that we made back in October 13th. At the time, a great bullish early reversal signal, green bar, oversold conditions, classic. This is what the ER signal trading system, ER1 and ER3 are built for, to pick those turning points. And we got this one, a whopper. I might add, we also had a great sell signal back April 5th. A very nice, not great, buy signal January 28th. And another pretty darn good one, November 22nd. And we had a bad one that didn't work, small loss, October 22nd of 2021. I think I covered most of these signals that we've got lately. This would be amazing if it were to get all the way below yesterday's lows today. We still wouldn't have an overbought condition, unfortunately. So obviously, I'm looking for a top right here. The trading range that we have so far, fairly narrow. If you are interested in doing something about it, my risk factor would be a close, at least for some significant portion of any bearish position you might take, a closing price above what we have for a high so far. If we start closing above today's highs, which were made a couple of hours ago, of course, I wouldn't like that a damn bit. That would be getting out of my shorts and taking some small losses. Now, on the other hand, I give it a little bit of time to start to prove itself if we're right, and see how far south it'll go and how quickly it'll do it. I think this is a very important day today. Let's go look at the DIA. The daily data on the DIA shows us that we have a higher high also today, earlier than yesterday, and we have already dropped down into approximately the middle of the range of yesterday. It seems to be giving up a larger percentage of yesterday's gain quicker, so it's a little bit weaker faster. Now, at the moment, we're still holding at the old highs a few days ago, excuse me, and the high that was made on August 16th. That is a minor level of support at the moment because we're trading above that level. That would be about 343 and a quarter. Currently 43.75, so it's just a very small amount. I want to go below that at a minimum and maybe even make new lows for the day. Again, if we break down really badly, this would generate a bearish engulfing outside down day ER sell signal, because we were actually above the overbought levels on my custom relative strength index within a few days. That would allow it to turn red and be a gigantic bearish engulfing. Don't see it happening. Very big range to drop, probably more than expected as far as I'm concerned at the moment. But we have a new high to work with, and guess what? It closed a very old gap, small, but there, April 21 to 22 on the DIA, there's a very small gap. So now that old gap is closed. Remember, I keep mentioning gaps are like a black hole in space that tend to suck everything back into it, the price range back into it. They are almost always closed, usually relatively soon, a few days, few weeks, but this one took months. Let's look at the QQQ. Daily data on the QQQ. Today's high is higher than the last couple of months. Nothing particularly spectacular about that. And getting close to some significant resistance as well, but didn't bump against it accurately at this point. It is down very little, only 19 ticks. So it's almost unchanged. And this was a new high and a new high close yesterday. So today we need to see some weakness. I'm not getting as much downside follow through momentarily as I am in some of the other indexes. S&P now down 80 instead of 50. I can't help it. There's too many things here that look like this rally may have spent itself. We are close to the major bear trend line, not at it like the S&P from the beginning of the bear market. We did catch the bottom on October 13th as an innumerable number of symbols and indexes and sectors, etc. That was a profoundly great October low. I started talking about back in probably August, at least in September, of course. So the Santa Claus rally is coming up. This is the 1st of December. I'll talk about that for just a moment. Typically, it is to buy something right before Christmas, generically said timing-wise, and it's your choice, but I'm talking about the indexes, specifically the S&P 500, and sell it in the first few days or maybe the first business day of January, but early January. We have researched this and we come up with some exact time of days and dates. I can tell you at this point, I would be buying, if I was buying a full position, let's say 100 lot, 33 shares, 3 days before Christmas. That's 3 trading days before Christmas. I think it's on a Sunday this year. And then a third, 2 trading days before Christmas. And the last third, 1 trading day before Christmas. Now, the trouble with the old Santa Claus rally technique is it has no money management to apply. I wouldn't let it go bad more than I could afford to and using my standard money management techniques, period. But the old adage is you sell it out in the early part of January, whatever happens in the meantime. I've seen some very spectacular events. Once, I think the chairman of the Federal Reserve on January 1st made a very bullish comment about interest rates, and all of a sudden the market shot up like a rocket for a day or two and made the trade go from a loss to a profit in the first trading day, 2nd and 3rd of January. That's the 3 days that you sell out of 1/3, 1/3, and 1/3. That's the 1st and 2nd and 3rd trading days of January. Now, I wouldn't do that necessarily. I'd use a trailing stop underneath the lows or at some appropriate level, whatever that means. And if market starts to rally more in the first week or 2 of January, I'd make more money, hopefully. That's it for today, December 1st. Market analysis, Stan Ehrlich. You have a great December. Merry Christmas a little early. Signing off.